Hi, welcome back to Financial Underwriting. This is part two of a four-part series. In this part, we're going to first talk a little bit about credit ratings and what you can or can't do or how they're going to help you in your analysis or underwriting. And then we're going to start diving into financial statements, more specifically, kind of what do they look like and how to find your way around a financial statement. Welcome back to Financial Underwriting. This is part two of a four-part series. In part one, we talked a little bit about the reasons why any underwriter, agent, or broker should actually perform financial reviews on their clients. In this part, we're going to start with talking about credit ratings and what they mean and what they can be used for, their shortcomings and what have you. Then we'll actually start to kind of learn to find our way around financial statements. Turning to credit ratings, they're based upon the business's past credit history. It basically examines how well they've paid their bills in the past. And there are two primary sources for commercial credit ratings. The first and most common is a D&B or Dun & Bradstreet, and you kind of have an example of how their credit ratings work there to the right. The other is Experian. Some companies prefer to use Experian, some use Dun & Bradstreet. But anyway, they both kind of do the same thing to get to the same purpose. And I've always kind of said that a credit rating is kind of a poor man's method of financial underwriting. It's kind of a basic thing to do to look at how well the company is performing financially. There are many advantages to utilizing credit ratings as a source to review the client's financial condition. The first advantage is that it's a very quick indicator. Over there, you see that the D&B, they rate somebody between a 1 and a 4. There's actually a 5 rating, I believe, that actually shows that they're actually bankrupt. So it's something quick. You know, an underwriter or an agent or broker could look at that and see actually where they rank. The other thing is it's actually readily available for most businesses. Almost all businesses, if they've been in business for a while and actually have been relying on credit, there is a credit rating out there for them. And again, maybe relating to that first being quick, it actually requires very little experience or expertise for an underwriter or agent to actually utilize it. They don't need to know how to calculate ratios or how to work around the financial statement. All they need is to be able to get the credit report and look at the rating. In many cases, credit ratings, they're actually very good and they're very acceptable for most small businesses. You know, you're not going to do an in-depth financial review of a mom and pop store, Main Street store. But there are some shortcomings of the credit ratings. The first is they're very superficial. They don't really dig too deep into the company. And the other thing is they don't really evaluate the true financial strength. But that I mean, it basically measures, the credit report measures how well they've been paying their bills. There are some businesses, and I'm not going to say it's right or wrong, there are some businesses that do not pay bills timely, and they do so that they hold on to their money as long as possible. Is this right? Is this wrong? I'm not saying it's one or the other, but you can have a company that is a slow bill payer, yet they're very strong financially. Like I said, the credit reports are a good first step and maybe will do the job for some small, uncomplicated risks. But if you really want to get an idea of the client or the insured's financial condition, you really will need to dig into their financial statements. Now, there's a lot of confusion as far as what is a financial statement. Usually, a lot of times when I would request a financial statement via email, more likely than not, all I got back was their profit and loss statement, which is part of the financial statements, but it's only one part. In order to really to do some financial analysis, you need all parts of their financial statement. Now, there are three distinct parts. The first is a profit and loss, or also called an income statement. The next is the balance sheet. Those first two, the balance sheet and the P&L statement, are key. You can do all the analysis that you need with just those two statements, but there's a third statement that is also helpful in doing analysis, and that is a cash flow statement. The profit and loss or income statement is probably the one type of financial report that people are most familiar with. And as the name kind of indicates, it shows whether the client is having a profit or loss. Obviously, the goal of any business is to make a profit, but the more important thing is that it's actually a measurement of their performance over a period of time. And the goal of the P&L statement or the information what you're trying to get from it is just how well are they doing. You start, if you look at the example over on the right hand side, you start with revenue. From that, you subtract what it costs of goods sold, other expenses. You throw in other income sources to you come up with a net income. And that net income is whether or not they're making a profit or a loss. And obviously, a profit is much preferred over a loss. That profit actually indicates that that company is actually performing well. That company is actually managing their operations well. The second part of financial statements is what is called a balance sheet. And a balance sheet actually looks at, it's sort of a snapshot of the overall business's health at that particular time when it is actually published. And what it does, it kind of lists and compares their assets to their liabilities to determine what their net worth is. And it's really an overall look at just how healthy is the business, just how liquid is the business, how well do they manage debt. Those are all things that you can kind of determine from looking at the balance sheet. The last portion of financial statements is what is called a cash flow statement. It's not critical to have a cash flow statement to be able to do some in-depth financial analysis, but it's always nice to have because it can explain some things. For example, the effect of depreciation on their bottom line. You could have a company that is losing money because of depreciation. Now, depreciation, while it is an expense, it's actually a paper expense. It's not something that a company is actually paying. They're not writing out a check to pay for depreciation. It's just the loss of value of some of their equipment. For example, your car, when you buy it and you drive it off a lot, it begins to depreciate. It doesn't mean that you're paying money out, but it is something that can impact the bottom line negatively. The other things that shows you where money is coming from. Is it coming from inventory? Is it coming from sales? Is it coming from investing operations? It's also going to show you where the cash is going. Where is all the money going out? Okay, so it's always good on a cash flow statement to see that there's more money coming in than going out. Similar to seeing on a profit and loss statement, seeing that they are actually incurring a profit. Let's turn our attention now to the different types of financial statements. The first I want to talk about is an audited financial statement. Now, an audited financial statement is where you have independent CPAs. They'll go out and review the company. They'll look at their books, maybe even do an inventory analysis, just to make sure that everything that is in the books or everything that the company says is accurate. It's also the most reliable because those CPAs, when they put their name on that report, they're actually making themselves both civilly and criminally liable for any mistakes they've made. Now you look over on the right hand side, you can usually tell an audited financial statement because it will have a letter talking about the opinion and what they went through to do the audit. Now, audited financial statements, while they are very reliable, they're not always required. If you're looking at a smaller or maybe medium-sized account, and you're not necessarily trying to look at a credit issue, working with an unaudited financial statement is probably fine as well. Now, with publicly traded companies that just like General Motors or whatever, you can actually go online and find their audited financial statements, because they actually have to publish them. They release them to the Securities Exchange Commission, and that's usually carried on the internet. You can use any financial site like Yahoo Finance, and you can usually find that financial statement, or you go to that company's website and go to investor relations, and you can usually look at any of their financial statements. A second type of financial statements would be unaudited financial statements. Now, like audited statements, they could be done and created by external accountants, CPAs, or maybe even just bookkeepers, or they could be done by internal accountants. The difference there is that they're actually not necessarily putting their name on the report and verifying of its accuracy. That being the case, they are less reliable than audited financial statements, but in a lot of cases, they are generally acceptable, particularly for medium and smaller accounts, and depending if you're using it just to get an idea for how good the account manages their business and things of that nature. I was once told by an agent when I requested financial statements that the insured didn't have any financial statements. Well, I asked him, I said, what do they have? Like a bucket that they put money in when they get money, and when they got to pay money out, they take money out of the bucket, and when the bucket's empty, they declare bankruptcy. The fact of the matter is tax returns are actually a financial statement. If you were to look at them, you would find that they incorporate most of the information that you would find on any financial statement. They are, in fact, annotated financial statements. And the good news is, like the story I told, is all businesses are required to file tax returns. Therefore, all businesses do have a financial statement. A Form 1065 is filed for both LLCs and partnerships. If you look over on the right-hand side, you'll see a portion of that financial statement looks exactly like a financial statement. It's got gross receipts, returns and allowances, cost of goods sold, gross profit, total income. It is part of, just like a profit and loss statement. A Form 1120 is to be filed for all corporations, and an 1120S for any sub S corporations. And looking over at the right hand side, you'll see that that's part of the tax return, and it looks pretty much like your ordinary balance sheet. And even nonprofits need to file tax returns, and a nonprofit would file a Form 990, and like the other forms over on the right hand side, you will see that they have a section that also looks pretty much like a typical balance sheet. So the question comes up quite often that what if the insured does not want to release their financial statements? You know, I've been pretty successful throughout my career when I explain why I need them, the fact that I'm going to look at them to be able to make some judgments about how well they manage their business, to be able to appropriately price and underwrite their account. More than likely, I do end up getting the financial statements. But even if there's still some resistance, we're really not looking for the entire financial statements. We're really looking for 9 data points, and those data points is the data that we need to use, that we need to be able to do the analysis to determine whether or not they are in a strong financial condition. So you can create a worksheet that identifies the exact data points that you need and have that insured or the agent complete that worksheet. Now, I do have a sample at the end of part 4 of what I have created to send out to agents. If you have any questions about the subject matter in this video, please leave the question in the comments below and I'll get back to you as soon as possible. Or you can email me directly at richard.uwresource@cox.net. And again, please remember to like this video and subscribe to our channel. The subject matter in this video is approved for CE credits in several states and available for in-house classes. If you are interested in scheduling an in-house CE session with us, please contact us via email at richard.uwresource@cox.net. And thank you for watching.